Welcome to your Q&A review for the WGU Corporate Finance exam. We'll work through real exam style questions, why each answer is right, why others are wrong, and the theory behind it. This guide covers Domain 1, the financial manager and business organization, including the financial manager's 3 core decisions, the goal of the firm and shareholder wealth, the agency problem and corporate governance, the main forms of business organization, hybrid structures and limited liability companies, the major types of mergers and combinations. Our website has free exam guides and practice questions to help you ace your D362 exam. Just check the link in the description below to access everything you need. It's all organized to help you study smarter, not harder, so you can prepare efficiently and walk into your exam feeling confident. Alright, let's dive in. Question 1. A regional manufacturing firm needs $40 million to fund a multi-year expansion and is deciding whether to issue new bonds, sell additional shares of stock, or use some blend of the two. Which of the financial manager's 3 key decisions does this choice represent? Your options are A working capital decision because it involves managing the firm's cash. B, a capital budgeting decision because the money funds an expansion. C, a financing decision because it concerns how the firm raises external capital and its debt versus equity mix. D, a dividend decision because issuing stock affects shareholders. Which one is it? Pause the video if you need more time. The correct answer is C, a financing decision because it concerns how the firm raises external capital and its debt versus equity mix. C is correct because the financing decision is the choice of how a firm generates external capital, including how much to raise and in what mix of debt and equity. Choosing between bond, stock, or a blend of the two is exactly that choice. A is wrong because working capital decisions manage short-term assets and liabilities like inventory and payroll cash, not the sourcing of long-term external funding. Raising $40 million for expansion is a long horizon funding choice. B is wrong because capital budgeting is about which long-term investments to make, not how to raise the money for them. The expansion project itself would be the capital budgeting decision. Funding it is separate. D is wrong because dividend policy concerns returning profit to owners, not raising new money. Issuing stock brings capital in rather than paying it out. The financing decision answers one question only. Where does a firm's outside money come from? Every dollar of capital arises from one of 2 broad sources, and the choice between them shapes everything about a firm's future obligations. Debt must be repaid on a fixed schedule and carries interest, but lenders get no ownership and no say in the business. Equity never has to be repaid and has no fixed schedule, but investors become permanent owners with a claim on profits and a voice in direction. Neither source is free, and the financing decision is the balancing act between them. This decision literally lives on the right-hand side of the balance sheet. The side listing claims against the firm, debt owed to lenders, and equity owned by shareholders. Setting the mix between them changes who has a claim on the firm's projects and on what terms, without touching the projects themselves. Not every big money choice is a financing decision. The test is whether the firm is raising capital or already deciding where to spend it. And financing is never settled once. A growing firm keeps adjusting its blend of debt and equity as interest rates and risk appetite shift. A skilled financial manager treats the debt versus equity balance as something to continuously adjust, because sound projects can still fail if they're financed the wrong way. Question 2. A growing landscaping company can fund a new headquarters either by borrowing through a bank, term loan, or by selling an ownership stake to an outside investor. The owner wants to keep full control and is willing to commit to fixed monthly payments. Which financing choice fits that priority and why? Your options are A. Debt, because lenders must be repaid on a fixed schedule but do not receive ownership or a vote in running the company. B. Equity, because selling a stake keeps monthly costs low and preserves control. C. Debt, because borrowed money never has to be repaid and carries no interest. D. Equity, because new owners share the risk and demand no claim on future profits. Take a second. Which answer would you pick? The correct answer is A. Debt, because lenders must be repaid on a fixed schedule but do not receive ownership or a vote in running the company. A is correct because debt has to be repaid on a fixed schedule with interest, but lenders do not get ownership or a vote in decisions, so the owner keeps full control. That matches an owner willing to take on fixed payments to avoid giving up a say. B is wrong because equity financing gives the new investor a claim on profits and a voice in the firm's direction, which directly reduces the owner's control. It does not preserve control the way the stem requires. C is wrong because debt must be repaid and it carries interest, so this reasoning is factually wrong. Only equity never has to be repaid. D is wrong because equity investors take a permanent claim on future profits in exchange for sharing risk. Saying they demand no claim on profits misstates how equity works. When a growing company needs money, it usually chooses between two very different bargains: borrowing from a bank or selling a piece of itself to an investor. On the surface, both hand over the same cash, but underneath they are almost opposite deals. Debt is money rented for a price. The lender is repaid on schedule with interest, then walks away, never becoming an owner. Equity is money exchanged for a permanent slice of the company. No fixed bill, but the investor now shares every future profit and often a vote in big decisions. The right choice depends on temperament and circumstance. An owner who wants control leans toward debt, accepting fixed payments to keep the whole firm. One who fears that burden or wants a partner's expertise leans toward equity instead. Steady, predictable revenue can carry debt safely, while lumpy or uncertain cash flow makes equity the safer fit. Picture the same company headquarters funded two ways: a bank loan demanding fixed interest payments with no ownership stake versus an investor's share demanding a permanent cut of profits and a vote. Same cash, two entirely different long-term claims on the firm. The trap is treating equity's softer short-run feel as though it were cheaper. It usually isn't. A skilled financial manager weighs the firm's cash flow, its owner's goals, and its risk tolerance to choose the blend that truly fits, not the one that merely feels easiest today. Question 3. A financial manager is reviewing how the firm's assets are funded and how the claims against the firm are structured. Decisions in this area determine what the right-hand side of the balance sheet looks like. Which decision category is being described? Your options are A. Capital budgeting, which sets the long-term assets on the left side. B. Financing, which determines the mix of claims such as debt and equity on the right side. C. Working capital, which balances current assets against current liabilities. D. Investment analysis, which ranks projects by net present value. Before I reveal it, which one do you think is right? The correct answer is B. Financing, which determines the mix of claims such as debt and equity on the right side. B is correct because financing decisions determine the right-hand side of the balance sheet, the claims against the firm, by setting the mix of debt and equity. That is precisely what the scenario describes. A is wrong because capital budgeting shapes the long-term assets on the left side of the balance sheet, not the claims on the right side. It concerns where money is deployed, not how it is raised. C is wrong because working capital involves current assets and current liabilities, the short-term items, rather than the overall structure of the firm's funding claims. The scenario points to how assets are funded broadly. D is wrong because investment analysis using net present value is a tool within capital budgeting for ranking projects, not the description of the balance sheet's claim structure. Every balance sheet has two sides that must agree, and the financing decision lives entirely on one of them. The left side lists assets, cash, inventory, buildings, and equipment. The right side lists the claims against those assets, split into liabilities, money that's borrowed, and equity, the ownership stake held by shareholders. Every asset on the left was paid for by someone on the right, either a lender or an owner, so the two sides must always balance. A delivery van on the left exists only because cash was raised on the right to buy it. Picture a manufacturer raising $40 million, $20 million in bonds and $20 million in new shares. The right side grows by $40 million in claims, while the left side grows by $40 million in cash, and only later does that cash shift into a factory. Two firms can own identical factories yet have very different right sides, one built on debt, one on equity, and that difference defines their risk. The right side of the balance sheet is a running record of every financing decision the firm has ever made. Question 4. A firm's board approves spending $60 million to build an automated distribution center expected to serve the company for the next 15 years. Even though the project requires a large amount of money, which of the three decisions does the choice to build it represent? Your options are A financing decision because $60 million must be raised. B, a working capital decision because a distribution center handles inventory. C, a dividend decision because large spending reduces funds available to shareholders. D, a capital budgeting decision because it commits capital to a major long-term asset judged on its future payoff. What's your answer? Commit to one before I continue. The correct answer is D, a capital budgeting decision because it commits capital to a major long-term asset judged on its future payoff. D is correct because capital budgeting is the choice of which major long-term investments to make, judged against whether they create value. Building a 15-year distribution center is a large, hard-to-reverse investment, so the decision to build it is capital budgeting. A is wrong because the need for money does not make this a financing decision. Financing is about how the funds are raised, debt versus equity, which is a separate question from whether to build the center. B is wrong because working capital manages short-term assets and liabilities, like inventory levels, not the decision to commit to a multi-year physical asset. The distribution center is a long-term commitment. C is wrong because dividend policy concerns paying profit to owners. The scenario is about investing in an asset, not distributing earnings. A big price tag doesn't automatically mean a decision is about financing. To classify it correctly, you have to look past the dollar sign and ask what's actually being decided. Capital budgeting is the process of evaluating whether a major, long-term investment is worth making. Its defining features are a large commitment, money locked up for years, and a payoff that arrives later as a stream of cash flows. The two decisions get confused because both involve serious money and often happen in the same season. But the cleanest test is direction. Money flowing into the firm is a financing decision, while money flowing out into a project or asset is a capital budgeting decision. Take the distribution center. Whether to build it depends on if 15 years of efficiency gains are worth $60 million today, a capital budgeting judgment. How the firm raises that $60 million through bond, stock, or retained earnings is a separate financing judgment that only comes after. Test writers love to mention money and hope you react to the word itself. But if the firm is deciding whether a long-lived project is worth pursuing, that's capital budgeting, no matter how loudly the financing is mentioned. Question 5. A financial manager describes the firm's cycle this way. Outside capital is raised. then deployed into long-term projects, and those projects throw off daily cash that must be managed before profits are reinvested or returned to investors. Which sequence correctly names the three decisions in that cycle? Your options are A. Financing, then capital budgeting, then working capital. B. Working capital, then financing, then capital budgeting. C. Capital budgeting, then working capital, then financing. D. Financing, then working capital, then capital budgeting. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Financing, then capital budgeting, then working capital. A is correct because the firm raises capital through financing decisions, deploys it through capital budgeting decisions into long-term projects, and those projects generate day-to-day cash that working capital decisions manage. That order is financing, capital budgeting, working capital. B is wrong because working capital does not come first, because there is no operating cash to manage until capital has been raised and invested. The cycle starts with raising money. C is wrong because capital budgeting cannot come first, because the firm must raise the money before it can commit it to long-term projects. Financing precedes investment. D is wrong because working capital does not precede capital budgeting. Long-term projects are chosen first, and only then do they generate the daily cash flows that working capital manages. The three financial management decisions are usually taught as separate boxes, but they actually form a loop, where each stage feeds the next. Money enters the firm, gets put to work, generates cash, and then either cycles back into new projects or flows back out to investors. The loop begins with financing, raising capital through borrowing or selling ownership, since nothing downstream can happen until money comes in. That capital is then deployed through capital budgeting, committed to long-term investments like plants, equipment, and product lines. Finally, working capital manages the daily churn of cash, paying wages and supplies while collecting from customers so operations never stall. Picture cash as it actually travels. Investors and lenders supply capital. Financing channels it forward. Capital budgeting turns it into long-term assets, and those assets throw off cash that working capital manages day to day. Whatever is left over either reinvests into new projects or flows back out to the people who supplied it, closing the loop. Because the stages are linked, a problem in one shows up everywhere else. Raise money on bad terms and fixed payments starve the projects. Choose a poor project and the expected cash never materializes, straining working capital. Mismanage working capital and even a profitable firm can't make payroll. Financing brings the money in. Capital budgeting puts it to work in long-term bets. And working capital keeps the daily lights on. Seen this way, the framework becomes a story about how a dollar moves through a company, not a list to memorize. Question 6. A heavy equipment maker is weighing whether the future labor savings from a $40 million automated welding line will justify its cost over the next 12 years. Which of the financial manager's three decisions is this? Your options are A. A working capital decision. B. A financing decision. C. A capital budgeting decision. D. A shareholder relations decision. Which would you go with? Lock it in before the reveal. The correct answer is C. A capital budgeting decision. C is correct because capital budgeting evaluates and chooses major, long-term investments by judging whether future returns justify the upfront cost. Weighing 12 years of savings against a $40 million outlay is the textbook capital budgeting decision. A is wrong because working capital covers short-term assets and liabilities and daily cash, not a 12-year investment in a productive asset. The horizon here is far too long for working capital. B is wrong because financing is about how to raise the money, not whether the welding line is worth buying. The STEM asks about evaluating the investment itself. D is wrong because shareholder relations is not one of the three key decisions. The three are financing, capital budgeting, and working capital. A $40 million welding line would cost the firm money today, but pay off slowly over the next 12 years. Deciding whether those distant benefits justify that immediate cost is exactly what capital budgeting is all about. The cost is easy to see, since it's the check the firm writes right now. The benefits are murkier, arriving in pieces over years and never fully guaranteed, since demand could soften or technology could age faster than expected. What separates these decisions from buying office supplies is scale and permanence. Once the money is spent and the equipment installed, the firm is largely stuck with the outcome, which is why these choices demand a careful, formal process rather than routine approval. Managers estimate the future cash flows an investment will produce, weigh them against the upfront cost, and account for the fact that money arriving years from now is worth less than money in hand today. The arithmetic is simple once the estimates are set, but those estimates embed assumptions about demand, prices, and costs that may not hold. Pressure testing those assumptions, not running the numbers, is where good and bad decisions truly part ways. Question 7. An analyst notes that a certain category of the firm's decision shares three traits. The commitments are large, the money is tied up for years, and the choices are difficult to reverse once made. Which category best fits that description? Your options are A. Working capital decisions, B. Dividend decisions, C. Financing decisions, D. Capital budgeting decisions. Don't overthink it. Which one feels right? The correct answer is D. Capital budgeting decisions. D is correct because capital budgeting decisions are the big, hard-to-reverse bets, such as building a factory or buying costly equipment, where money is committed for years. The three traits named match capital budgeting precisely. A is wrong because working capital decisions are short-term and frequently adjusted, such as inventory and payroll timing, so they are neither long-lived nor hard to reverse. They are the opposite of what is described. B is wrong because dividend decisions can be changed period to period and do not tie up money in long-lived assets. They concern distributing profit, not committing capital for years. C is wrong because financing decisions concern how money is raised and can be restructured over time. The description of large, long-lived, hard-to-reverse asset commitments points to capital budgeting instead. Capital budgeting decisions are big, long-lasting, and hard to undo. Recognizing these three traits is what separates a true capital budgeting decision from ordinary spending that just looks like one. Size raises the flag since these commitments involve substantial sums requiring senior approval. But size alone can be misleading, since a firm can spend heavily on something short-lived like bulk raw materials without it being capital budgeting. Duration and irreversibility are what truly confirm it. Consider a logistics firm buying trucks it will run for 10 years. The outlay is large. The asset serves for a decade, and reselling early recovers only a fraction of its cost. A textbook capital budgeting decision. Compare that to stocking diesel for next month, small, immediate, and easily changed. The trucks commit the firm's future. The diesel merely oils its present. Working capital decisions are small, short-term, and constantly adjusted. Financing decisions can be large and long-lasting, but they can be restructured through refinancing or new share issues. Capital budgeting alone combines all three traits at once: size, duration, and irreversibility. It's tempting to fixate on the dollar amount, but the real question is how stuck the firm will be if the decision proves wrong. A large but flexible commitment can be corrected. A smaller, truly locked-in one cannot. Question 8. Because a proposed investment's benefits arrive as cash flows spread across many future years, The firm evaluates it with formal tools such as net present value, internal rate of return, and payback period. These tools are the standard toolkit for which type of decision. Your options are A. Working capital decisions, B. Capital budgeting decisions, C. Financing decisions, D. Tax planning decisions. Got a guess? Lock it in. The correct answer is B. Capital budgeting decisions. B is correct because capital budgeting relies on formal investment metrics like net present value, internal rate of return, and payback period because the cash flows come in the future and must be judged against the upfront cost. Those tools define the capital budgeting process. A is wrong because working capital decisions manage near-term cash and do not use long-horizon discounting tools like net present value. Their focus is keeping enough cash on hand day to day. C is wrong because financing decisions weigh the cost and mix of debt and equity, not the ranking of long-term projects by net present value or internal rate of return. Those metrics evaluate investments, not funding sources. D is wrong because tax planning is not one of the three key decisions, and net present value and payback are investment evaluation tools rather than tax tools. When an investment's payoff arrives as a stream of cash spread across many years, gut instinct falls short. So firms rely on formal capital budgeting tools to decide whether it's worth more than it costs. The reason these tools exist comes down to a stubborn fact. Money now can be invested and grow, and it's certain, while money promised later is both delayed and risky. That gap is exactly what raw totals ignore. Net present value discounts every future cash flow and subtracts the upfront cost, giving a dollar figure of value created. Internal rate of return expresses the same idea as a percentage compared against a required threshold. Payback period simply asks how many years it takes to recover the original cost. Net present value is the cleanest expression of this logic, shrinks each future cash flow to reflect how far off and uncertain it is. Add them up, then subtract the initial cost. A positive result means the investment creates value. A negative one means it destroys it. Every metric is only as trustworthy as the cash flow forecast behind it. So a capable manager checks the inputs as carefully as the outputs. Since each tool has its own blind spot, using more than one often reveals exactly where the real questions about a project are hiding. Question 9. A firm is choosing between two uses of cash: purchasing a building it will operate out of for 20 years, or increasing the inventory it holds to meet next month's orders. How are these two choices best classified? Your options are A. The building is capital budgeting. The inventory increase is working capital. B. Both are capital budgeting decisions because both involve buying assets. C. The building is working capital. The inventory increase is capital budgeting. D. Both are working capital decisions because both use current cash. Which one is it? Pause the video if you need more time. The correct answer is A. The building is capital budgeting. The inventory increase is working capital. A is correct because a 20-year operating building is a major long-term asset, which makes it a capital budgeting decision, while inventory to meet next month's orders is a short-term asset managed as working capital. The two choices fall into different buckets by time horizon. B is wrong because inventory held to meet next month's demand is a short-term current asset, not a long-term investment. So it is working capital rather than capital budgeting. Not every asset purchase is capital budgeting. C is wrong because this reverses the correct classification. A 20-year building is long-term capital budgeting, and short-term inventory is working capital, not the other way around. D is wrong because a 20-year building is a long-lived asset and cannot be working capital, which covers only short-term items. Using cash today does not by itself make a decision working capital. Two purchasers can both spend cash today and still belong to completely different kinds of decisions. Telling them apart comes down to one simple test. Buying a building the firm will use for 20 years and buying inventory to cover next month's orders both cost money, but the dollar amount and the fact that something is purchased don't decide the category. What matters is the time horizon and the role the asset plays. Capital budgeting covers long-lived assets like a building, judged by whether long-run benefits justify the cost. Working capital covers short-term assets like inventory, judged by turnover and whether the firm holds just enough without tying up extra cash. A building sits fixed on the balance sheet for years, defined by permanence. Inventory cycles through in weeks, converted to cash and replaced, defined by turnover. The two decisions are managed differently too. A building purchase is judged once by senior management with discounting tools, while inventory is reviewed constantly by operations staff. Get the horizon right and you'll always place the decision correctly. Question 10. A packaged foods corporation is deciding whether to acquire a smaller rival for a large sum, expecting the purchase to generate returns for years to come. Setting aside how the purchase will be funded, the decision of whether the acquisition is worth making is best classified as which type of decision? Your options are A working capital decision, B, a dividend decision, C, a capital budgeting decision, D, a financing decision. Take a second. Which answer would you pick? The correct answer is C, a capital budgeting decision. C is correct because acquiring another company is a major, long-lived investment judged on its future returns, which places it squarely in capital budgeting. The course lists acquiring a firm alongside building a plant as a capital budgeting example. A is wrong because working capital handles short-term operating items, not a multi-year acquisition expected to pay off over years. The horizon and scale rule out working capital. B is wrong because a dividend decision distributes profit to shareholders and has nothing to do with evaluating whether to buy another company. D is wrong because how the acquisition is funded would be a financing decision, but the STEM specifically sets funding aside and asks about whether the investment is worth making, which is capital budgeting. Buying another company might look like a world apart from buying a machine, but financially they're cousins. An acquisition is just a large, long-term investment judged by the returns it's expected to produce. The buyer pays a substantial cost up front, expecting future benefits like higher sales, lower costs, new markets, or valuable brands. The question is always whether those future benefits, properly valued, exceed the price paid today. A common mistake is treating a purchase as wise simply because the firm can afford it or the target is available. But a cash-rich firm can still overpay for an acquisition that never earns back its price, destroying value just as a badly chosen factory would. First comes the capital budgeting question. Is the rival worth acquiring, given the future cash flows it would generate? Only afterward does financing enter the picture, whether cash, debt, or new shares. That's a separate decision, not a substitute for the first. Growth by acquisition is still an investment, and investments live or die by whether they earn more than they cost. Stripping away the drama puts the right question at the center. Not how bold the deal is, but whether it's worth the price. Question 11. A retailer arranges a short-term line of credit to buy extra inventory ahead of the holiday season, planning to repay it once holiday sales convert to cash. Which of the three key decisions does managing the short-term gap represent? Your options are A, a capital budgeting decision, B, a financing decision that permanently changes the firm's structure, C, a dividend decision, D, a working capital decision. Before I reveal it, which one do you think is right? The correct answer is D, a working capital decision. D is correct because working capital decisions manage short-term assets and liabilities, so the firm has enough cash to operate day to day, including bridging the gap between buying inventory and collecting sales. A short-term line of credit for seasonal inventory is exactly that. A is wrong because capital budgeting commits money to major long-term assets for years, not to short-term seasonal inventory repaid within months. The horizon here is far too short. B is wrong because while a line of credit is borrowing, its purpose here is short-term cash management rather than a permanent change to the firm's capital structure. The course classifies covering near-term operating needs as working capital. C is wrong because dividend policy concerns paying profit to owners, which is unrelated to bridging a seasonal inventory gap. Before the holiday rush, a retailer must buy inventory now, but the cash from sales won't arrive until later. A short-term line of credit bridges that gap, and that timing maneuver is what defines a working capital decision. Working capital lives in the rhythm of weeks and months, not years. It means paying workers and vendors on time, collecting from customers, holding the right amount of inventory, and making sure cash is there to cover bills before revenue arrives. The same borrowing tool can belong to different decisions depending on its purpose. Financing sets a firm's lasting capital structure for years, while working capital is short-term, self-reversing, and purely about timing cash flows within one operating cycle. Picture the cycle. Inventory is purchased using a short-term credit line, holiday sales bring in cash, and that cash repays the credit before the cycle starts again. Nothing permanent about the firm changes, it simply smooths a predictable crunch. Working capital rarely makes headlines, but a firm with great long-term prospects can still stumble if it can't cover this month's payroll. Done well, it's invisible. Done poorly, it can topple a company that looked perfectly healthy on paper. Question 12. A financial manager wants a single figure that captures the cushion of short-term resources a firm holds over its short-term obligations. Which calculation produces that figure? Your options are A. Total assets minus total equity. B. Current assets minus current liabilities. C. Revenue minus operating expenses. D. Net profit minus dividends paid. What's your answer? Commit to one before I continue. The correct answer is B. Current assets minus current liabilities. B is correct because net working capital equals current assets minus current liabilities, the cushion of short-term resources over short-term obligations. That is the exact measure the manager is looking for. A is wrong because total assets minus total equity yields total liabilities, not the short-term cushion. It mixes long-term and short-term items rather than isolating current ones. C is wrong because revenue minus operating expenses approximates operating profit, an income statement figure, not the balance sheet measure of short-term resources over obligations. D is wrong because net profit minus dividends is retained earnings for the period, which measures reinvested profit, not the cushion of current assets over current liabilities. Net working capital is one subtraction that reveals a firm's short-term health, current assets minus current liabilities. Current assets are what a firm expects to turn into cash within a year. Cash itself, accounts receivable owed by customers, and inventory waiting to be sold. Current liabilities are the obligations coming due in that same short window. Accounts payable owed to suppliers, wages soon to be paid, short-term borrowings, and other near-term bills. Picture $300,000 in current assets set against $200,000 in current liabilities. The gap. $100,000 is the cushion that lets a firm absorb slow collections or surprise bills without scrambling. Remember, net working capital measures liquidity, not profit. A firm can be profitable yet still cash-strapped. Watching that gap is watching the margin of safety between a firm's ability to pay and its obligation to do so. Question 13. A bakery buys flour and pays its bakers every 2 weeks, but does not collect from its wholesale grocery accounts for 45 days. Ensuring cash is available to cover wages and ingredients before the grocery payments arrive is an example of which decision? Your options are A. A working capital decision, B. A capital budgeting decision, C. A financing decision about capital structure, D. A decision about maximizing the share price directly. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. A working capital decision. A is correct because managing the timing gap between paying for inputs and collecting from customers, so there is always cash to cover obligations, is the heart of working capital management. The bakery is managing receivables, payables, and payroll cash. B is wrong because capital budgeting concerns long-term asset investments, not the short-term timing of cash coming in and going out. Nothing here involves a multi-year project. C is wrong because, although a short-term line of credit might help, the decision described is about managing daily cash flow, not setting the firm's long-term debt versus equity structure. D is wrong because share price maximization is the firm's overall objective, not one of the 3 operational decision categories. The activity described is specifically working capital. Money rarely arrives on the same schedule it departs. A bakery pays for flour and wages continuously, but waits 45 days to collect from its grocery customers. And managing that mismatch is working capital management at its most concrete. 3 moving parts drive the timing problem. Payables are what the firm owes suppliers, and when those bills come due. Receivables are what customers owe, and when they'll actually pay. Payroll is the steady, non-negotiable obligation to employees that arrives like clockwork, regardless of whether customers have paid. The bakery makes the mechanics vivid. It pays for ingredients and labor continuously, week in and week out, while its grocery customers pay on terms stretching more than a month past delivery. Something has to cover that gap. Or the bakers don't get paid on Friday even though the business is profitable over the quarter. Managing that gap involves a handful of levers: collecting receivables faster with small early payment discounts, negotiating longer terms with suppliers, holding a cash reserve as a buffer, and arranging a short-term line of credit to draw on during the lean stretch. A business can book a healthy margin on every loaf sold and still fail if it can't bridge the wait for payment. Working capital is the quiet, ongoing discipline of synchronizing cash flows, so a profitable enterprise never stumbles over its own timing. Question 14. A consultant observes that some companies show healthy profits on their income statements, yet still collapse. According to the course, which failure most directly explains a profitable-looking firm running into trouble in the short run? Your options are A. Paying too little in dividends to shareholders, B. Choosing too much equity in its capital structure, C. Running out of cash to meet obligations like payroll, D. Using net present value to evaluate its projects. Which would you go with? Lock it in before the reveal. The correct answer is C. Running out of cash to meet obligations like payroll. C is correct because the course stresses that firms live or die in the short run on working capital, and plenty of profitable on paper companies have failed because they ran out of cash to make payroll. Poor cash management, not weak profit, is the short run killer. A is wrong because paying too little in dividends does not cause a short run collapse. If anything, it conserves cash. The described danger is about liquidity, not payout policy. B is wrong because an equity-heavy structure carries no repayment obligation and is not what causes a profitable firm to suddenly run short of operating cash. The issue is timing of cash, not the debt-equity mix. D is wrong because he net present value is a sound tool for evaluating investments and is not a cause of failure. The collapse described comes from a cash shortfall, a working capital problem. Here's a puzzle that trips up new business students. A company can report healthy profits and still collapse. That sounds impossible, but it comes down to one crucial distinction. Profit and cash are not the same thing. Profit is an accounting measure. It records revenue earned and expenses incurred, whether or not cash has actually changed hands. Cash, by contrast, is what's really sitting in the account, available to pay bills today. A firm can look profitable on paper while its cash is stuck in unpaid invoices and unsold inventory. Picture a fast-growing firm booking strong sales, but paying suppliers and workers weeks before customers pay it back. Every new sale actually deepens the cash gap because money goes out long before revenue comes in. Growth looks like triumph on the income statement while quietly draining the bank account. Working capital is the defense against this exact fate. It means watching the timing of collections and payments, keeping a sensible cash buffer, and arranging short-term credit before it's desperately needed. Poor working capital management is the mechanism by which a profitable business actually dies. A firm can survive thin profits if it has cash, but it cannot survive a lack of cash no matter how profitable it looks. Profit is the score at the end of the period. Cash is what pays the bills along the way. And working capital makes sure the second never runs out. Question 15. Of the financial manager's 3 key decisions, a new analyst wants to know which one operates on the shortest time horizon and is revisited most frequently in daily operations. Which is it? Your options are A. Capital budgeting, B. Working capital, C. Financing, D. All 3 share the same horizon. Don't overthink it. Which one feels right? The correct answer is B. Working capital. B is correct because working capital decisions are the daily blocking and tackling of keeping cash flowing, making them the shortest horizon of the 3 and the most frequently revisited. They deal with the near term rather than multi-year commitments. A is wrong because capital budgeting involves long-term investments whose money is tied up for years, so it has the longest horizon, not the shortest. It is revisited far less often. C is wrong because financing decisions set the firm's longer-term capital structure and are not the day-to-day choices. They operate over a longer horizon than working capital. D is wrong because the 3 do not share the same horizon. Financing and capital budgeting are long-term, while working capital is short-term, which is the whole point of the distinction. A financial manager owns 3 decisions, and sorting them by time horizon is the cleanest way to keep them straight. The longer a decision's effects last, the less often it needs to be revisited, and the shorter its effects last, the more constant the attention it demands. Capital budgeting ties up money in factories and equipment for a decade or more, so it's made rarely, with formal analysis and senior approval. Financing sets the firm's debt-equity mix and reshapes its structure for years, so it's adjusted only periodically. Working capital covers daily bills, inventory, and cash on hand, so it's managed continuously. Picture all 3 decisions placed on a single timeline. Working capital clustered at the near end, financing in the middle, and capital budgeting stretching out to the far end. Horizon and frequency move together along that same line. Working capital is the pulse of the business, beating daily while operations and treasury staff watch cash and turnover. Senior leaders, meanwhile, step in only occasionally for the big financing and investment calls, matching their attention to the slower rhythm of those decisions. Capital budgeting is the longest and least frequent. Financing sits in between, and working capital is the shortest and most constant. Once you can place any decision on that timeline, You can classify it just by asking how long its effects last and how often it recurs. Question 16. A newly hired manager asks, what single objective should guide every financing, investing, and operating choice in a standard corporation whose charter says nothing to the contrary? What is the correct answer? Your options are A. Maximize this year's reported accounting profit. B. Maximize the firm's market share. C. Minimize the firm's operating cost. D. Maximize stockholder wealth, measured as the current share price. Got a guess? Lock it in. The correct answer is D. Maximize stockholder wealth, measured as the current share price. D is correct because the primary objective of a standard corporation is to maximize stockholder wealth, measured concretely as the current market price per share, unless the charter states otherwise. Every decision is supposed to serve that measure. A is wrong because maximizing accounting profit is rejected as the goal, because profit ignores timing and risk and can be manipulated. It is a means at best, not the objective. B is wrong because market share can be part of a strategy, but it is not the firm's primary financial objective. A firm can gain share while destroying value. C is wrong because minimizing costs is one possible tactic, not the guiding objective. Cutting costs that damage the firm's future would lower, not raise, shareholder wealth. Every financial decision needs a yardstick, a single standard for judging good from bad. In a standard corporation, that standard is clear: maximize stockholder wealth, the objective that sits above every other consideration. Stockholder wealth means the current market value of the owner's stock. Maximizing it means maximizing the price per share, giving the manager a specific, usable test. Does this decision raise share value or not? Financing decisions, capital budgeting decisions, and working capital decisions are all supposed to serve this single end. Without one unifying objective, a manager would have no principled way to choose among competing options. Shareholders own the corporation and supplied its equity capital, but they stand last in line, paid only after lenders, suppliers, and employees. Because they own whatever remains, their stake reflects the health of the whole enterprise. This objective is a discipline that forces every proposal to answer the same demanding question. A corporation exists to build value for its owners, and holding that measure steady turns separate decisions into one coherent strategy. Question 17. Finance deliberately rejects profit maximization as the firm's goal. Which explanation best captures why share price maximization is preferred instead? Your options are: A. Share price reflects the timing and risk of future cash flows and resists accounting manipulation, all of which profit maximization ignores. B. Profit figures are always fraudulent, while share prices are guaranteed accurate. C. Profit cannot be measured at all, so it is useless as a goal. D. Maximizing profit is prohibited by law for public corporations. Which one is it? Pause the video if you need more time. The correct answer is A. Share price reflects the timing and risk of future cash flows and resists accounting manipulation, all of which profit maximization ignores. A is correct because profit maximization has three weaknesses. It ignores the timing of cash flows, ignores risk, and can be manipulated by accounting choices. Share price fixes all three because it reflects the present value of risky future cash flows and is hard to fake for long. B is wrong because profit figures are not always fraudulent and share prices are not guaranteed accurate. The real issue is that profit ignores timing and risk, not that it is always fraud. C is wrong because profit can be measured. The problem is that it can be measured in misleading ways and ignores timing and risk. Immeasurability is not the objection. D is wrong because there is no law prohibiting profit maximization. Finance rejects it on conceptual grounds, not legal ones. It seems obvious that a company should maximize profit, but finance treats that instinct as a trap. Profit has three specific weaknesses, and the true objective, maximizing share price, exists precisely because it fixes all three. Profit maximization has three flaws. It ignores timing, treating $1 today the same as $1 in 5 years. It ignores risk, applauding gains even when they come from reckless gambles. And it's ambiguous and manipulable, since accounting choices or cuts to research and maintenance can inflate the number without real improvement. Share price maximization repairs each weakness. Market value already reflects the present value of expected future cash flows, so timing is built in. Investors discount risky prospects, so recklessness lowers the price instead of raising it. And because markets are forward-looking, accounting tricks that pump up profit without real substance tend not to lift the stock. Consider a firm that cancels all its research to boost this year's earnings. Profit rises immediately, a win by the profit standard, but investors see the firm mortgaged its future, so the share price falls, correctly flagging the move as value destroying. Profit is easy to celebrate, which makes it seductive, but it's only a signal, sometimes honest, sometimes manipulated. The real objective is the value of the owner's stake, because that's what truly accounts for timing and risk. Question 18. A firm states that its goal is to maximize stockholder wealth. In concrete terms, which measurable quantity is the firm trying to maximize? Your options are A. The total dividends paid this year. B. The book value of the firm's total assets. C. The current market price per share of the firm's common stock. D. The firm's annual sales revenue. Take a second. Which answer would you pick? The correct answer is C. The current market price per share of the firm's common stock. C is correct because stockholder wealth is measured concretely as the current market value of the owner's stock, which means the price per share of the firm's common stock. Maximizing owner's wealth means maximizing that share price. A is wrong because dividends are one-way profit reaches owners, but the wealth measure is the market value of their shares, which reflects far more than a single year's payout. A firm can create wealth while paying no current dividend. B is wrong because book value of assets is an accounting figure that often diverges from market value and does not capture the owner's wealth. Share price, a forward-looking market judgment, is the intended measure. D is wrong because sales revenue measures activity, not owner wealth. A firm can grow revenue while its share price falls. Maximizing stockholder wealth sounds noble but vague, so finance pins it to something concrete, the current market price per share of the firm's common stock. Shareholders own the corporation through their shares, and their wealth is simply the market value of those holdings, price multiplied by number of shares, since the share count is fixed. Maximizing stockholder wealth and maximizing share price mean exactly the same thing. Unlike backward-looking accounting figures such as book value or reported earnings, market price reflects what investors expect the firm to earn in the future, discounted for timing and risk. Consider a firm that invests heavily in a promising new capability, taking a hit to this year's earnings. By earnings alone, the firm looks worse, but if investors judge the investment strengthens the future, the share price can still climb. Because share price rests on expectations that reality eventually tests, it cannot be gained by cosmetic moves. That is why finance ties the firm's objective to the single, visible, forward-looking number. Question 19. A corporate law professor describes a doctrine holding that creating value for shareholders, above all other considerations, should control every action a corporation takes. Which term names this doctrine? Your options are A. The agency problem. B. Stakeholder theory. C. Fiduciary neutrality. D. Shareholder primacy. Before I reveal it, which one do you think is right? The correct answer is D, shareholder primacy. D is correct because shareholder primacy is the idea that creating value for shareholders above all else controls every consideration and action the corporation takes. That matches the professor's description exactly. A is wrong because the agency problem is the risk that managers pursue their own interests instead of the owner's goal, not a doctrine about prioritizing shareholders. It names a conflict, not a priority rule. B is wrong because stakeholder theory broadens focus to employees, customers, and community, which is the opposite of prioritizing shareholders above all. It is the counterpoint to the doctrine described. C is wrong because fiduciary neutrality is not a recognized term in the course. The doctrine that shareholder value governs everything is shareholder primacy. Beneath the goal of maximizing share value sits a deeper principle about whose interests come first, known as shareholder primacy. It holds that creating value for shareholders controls every decision a corporation makes, and that when interests compete, the owner's claim wins. The doctrine rests on a simple ownership argument. Shareholders own the corporation. Managers and directors are hired as their agents. And so the manager's duty runs to the shareholders, whose interest is understood as the value of the shares. Supporters say a single master keeps managers focused and accountable, since answering to everyone means answering to no one. Critics counter that corporations affect far more than shareholders, and placing owners above all else can license harm to workers and communities. Yet the doctrine hides an escape clause. A charter can state otherwise, letting a firm broaden its duties. Picture the chain of duty. Shareholders sit at the top as owners. Managers and directors act as their agents beneath them. And every corporate action flows downward, bound by a duty of loyalty back to the owners. The key distinction to hold on to is that shareholder primacy is a default, a legal system, and a company choose, not an inevitable law. Naming it clearly shows exactly what mission-driven alternatives are pushing against. Question 20. In a large corporation, the shareholders who own the firm are usually different people from the managers who run it. Concerned that the managers might pursue job security, perks, and empire building instead of maximizing owners' wealth is known as what? Your options are A. Shareholder primacy, B. The agency problem, C. Double taxation, D. The working capital gap. What's your answer? Commit to one before I continue. The correct answer is B. The agency problem. B is correct because the agency problem is the risk that managers, the agents who control the firm day to day, will pursue their own interests rather than maximizing the owner's wealth. Job security, perks, and empire building are the classic examples. A is wrong because shareholder primacy is the principle that shareholder value comes first, not the conflict between managers and owners. It describes the goal, not the obstacle. C is wrong because double taxation is the corporate tax drawback, where profits are taxed at the company level and again as dividends. It has nothing to do with the manager-owner conflict. D is wrong because the working capital gap concerns short-term cash timing, not the divergence between managers' and owners' interests. In a large corporation, the owners and the managers are not the same people. Shareholders own the firm, but hired managers actually run it, and that separation opens the door to conflict. The agency problem is the risk that managers, who are supposed to act as agents for the shareholders who own the firm, instead pursue their own interests instead of maximizing owner wealth. Self-interest shows up in familiar forms: empire building to inflate salary and prestige, perks like lavish offices and jets, and playing it safe to protect a job rather than take risks that serve shareholders. This persists because managers know more about the business than distant owners do, and information gap owners can't easily close. Because owners don't run the firm day to day, they can't directly observe every decision managers make. Corporate governance, boards, incentive pay, audits and regulation exists specifically to bridge that gap and keep managers pointed towards shareholder wealth. The very structure that lets a corporation raise capital from many owners also separates ownership from control, making the agency problem the chief obstacle between a firm's goal and achieving it. Question 21. A freelance graphic designer operating under her own name with no special filings signs a contract that goes badly and is sued for an amount larger than her business holds. What is her exposure? Your options are: A. Her liability is capped at the amount she invested in the business. B. Only the business's assets can be taken, not her personal assets. C. Her personal assets, such as her home and savings, are exposed because she and the business are legally the same. D. Her clients must cover the shortfall under partnership rules. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Her personal assets, such as her home and savings, are exposed because she and the business are legally the same. C is correct because a sole proprietor has unlimited personal liability because there is no legal distinction between the owner and the business. Legally, the owner is the business. Creditors can pursue her home, car, and savings if the business cannot pay. A is wrong because a capped, invested only liability describes limited liability, which sole proprietors do not have. There is no legal wall protecting her personal assets. B is wrong because owner and business are legally identical in a sole proprietorship. Personal assets are not shielded from business debts. The separation that would protect them does not exist. D is wrong because there are no partners in a sole proprietorship, and clients do not assume the owner's business debts. Partnership rules do not apply here. A freelance designer runs her business under her own name, keeps every dollar she earns, and files no special paperwork. Then a client sues. The judgment exceeds everything the business owns, and it reaches straight into her house, her car, and her savings. A sole proprietorship is a business owned and run by one person with no legal distinction between the two. It's the simplest way to own a business. But that same lack of separation means the business's debts become the owner's debts without limit. Because the law treats the owner and the business as one, everything the owner personally owns, her house, her car, her savings, sits in the same pool as the business. A creditor with a valid claim can draw from that entire pool, not just what the business owns. Compare this to a corporation or LLC, where an owner can lose only what they invested, with personal assets protected behind the entity. The sole proprietor has no such shield, so a single bad contract or lawsuit can reach far beyond the business into private life. Unlimited liability is the price of the sole proprietorship's simplicity. That trade is fine for low-risk ventures, but once real debt or real risk enters the picture, forming a limited liability entity becomes the wiser move. Question 22. An advisor lists the features of a one-owner business with no separate legal identity. Easiest and cheapest to start, owner keeps all profits, and income is reported on the owner's personal return. Which additional feature correctly completes this profile of a sole proprietorship? Your options are: A. The business ends when the owner quits, retires, or dies because its life is tied to the owner. B. The business enjoys perpetual life independent of the owner. C. Profits are taxed twice, once at the business level and again personally. D. The owner's liability is limited to the amount invested. Which would you go with? Lock it in before the reveal. The correct answer is A. The business ends when the owner quits, retires, or dies because its life is tied to the owner. A is correct because a sole proprietorship's continuity is weak because its life is tied to the owner. So it ends if the owner quits, retires, or dies. That is the standard drawback paired with its simplicity and single taxation. B is wrong because perpetual life belongs to the corporation, which is separate from its owners. A sole proprietorship cannot outlive its single owner. C is wrong because a sole proprietorship is taxed once, on the owner's personal return, with no separate business tax. Double taxation is the corporation's drawback, not the proprietorship's. D is wrong because limited liability is not a feature of a sole proprietorship. The owner has unlimited personal liability. Its life ending with the owner, not a liability cap, completes the profile. Beyond unlimited liability, two features define the sole proprietorship: how it's taxed and how long it lasts. Both trace back to a single root fact: the business and its owner are legally one and the same. Because there's no separate legal entity, the business's income is simply the owner's income, and the business's life is simply the owner's life. Everything else follows from that single fusion. On the upside, profits are taxed once, on the owner's personal return, with no separate business level tax like a corporation faces. On the downside, the business has no life apart from its owner, so when the owner quits, retires, sells, or dies, the business legally ends with them. Picture the owner and the business as a single, fully overlapping entity rather than two separate circles. From that one merged identity, both the tax simplicity and the fragile lifespan naturally flow outward. Single taxation and limited life aren't unrelated quirks to memorize. They're both expressions of the same fact. The owner and the business are legally identical. Question 23. Two friends run a landscaping business as a general partnership. One partner alone signs a large equipment lease. The business then cannot pay. Who can the creditor pursue? Your options are: A. Only the partner who physically signed the lease. B. Only the business's own assets, never the partner's personally. C. Neither partner, because partnerships carry limited liability. D. Both partners personally, because general partners share unlimited liability for the firm's debts. Don't overthink it. Which one feels right? The correct answer is D. Both partners personally, because general partners share unlimited liability for the firm's debts. D is correct because general partners each have unlimited personal liability for the firm's debts, and often for one another's business actions. So creditors can pursue both partners' personal assets, not just the one who signed. A is wrong because liability in a general partnership is joint, so it is not limited to the partner who signed. The other partner is equally exposed. B is wrong because general partnerships do not shield partners behind the business's assets. Personal assets are at risk. That shield is a feature of corporations and LLCs, not general partnerships. C is wrong because general partnerships carry unlimited, not limited liability. Only limited partners, corporate shareholders, and LLC members enjoy a liability cap. Two friends start a landscaping partnership. One signs a huge equipment lease alone. The business can't pay, and both partners are personally on the hook for the full amount. That's the defining risk of a general partnership. A partnership is owned by two or more people who share profits, losses, and management. The general partnership is the basic version. Easy to form, it pools resources, and its income passes through to be taxed only once on the partner's personal returns. Because liability is joint and unlimited, a creditor can chase either partner's personal assets for the whole debt, no matter who actually signed. The partner who stayed out of the deal can end up paying for all of it, then have to seek reimbursement from the other. This is why choosing partners is such a weighty decision. One partner's bad judgment or reckless spending can land on everyone. Compare that to a corporation, where a shareholder's exposure is capped and one owner's mistakes never reach another's personal wealth. A general partnership multiplies the sole proprietor's liability rather than dividing it, linking each partner's personal fortune to the conduct of the others. That's exactly why many people choose a limited liability form instead. Question 24. In a limited partnership, a limited partner who had stayed out of daily operations begins actively managing the business. According to the course, what is the main risk she now faces? Your options are: A. Her share of profits is automatically doubled. B. She can lose the limited liability protection that depended on not managing the business. C. The partnership is automatically converted into a corporation. D. The business immediately becomes subject to double taxation. Gotta guess. Lock it in. The correct answer is B. She can lose the limited liability protection that depended on not managing the business. B is correct because a limited partner's liability shield exists precisely because she stays out of management. If she starts running the business, she can lose that protection, which is the classic control for liability trade-off. A is wrong because taking on management does not automatically double her profit share. Profit splits are set by the partnership agreement. The real consequence is to her liability shield. C is wrong because actively managing does not convert a partnership into a corporation. Changing legal form requires a deliberate filing, not a shift in a partner's role. D is wrong because partnerships are passed through and taxed once, regardless of who manages. Managing does not trigger double taxation, which is a corporate feature. Not every partner in a partnership carries unlimited liability. A limited partnership works because of one elegant trade-off: control for protection. General partners run the business and accept unlimited liability. Limited partners put up money, stay out of management, and get their liability capped at what they invested. The shield exists precisely because the limited partner does not control the business. Someone who neither decides nor operates isn't held personally responsible for the debts those operations create beyond their stake. If a limited partner steps out of the passive role and starts directing operations like a general partner, they risk forfeiting the very protection that defined their position. The protection is conditional, and the condition is staying out of management. The general partner trades protection for control. The limited partner trades control for protection. Neither gets both, and that clean symmetry is the essence of the limited partnership. Question 95. An advisor warns a two-person general partnership about two structural weaknesses beyond liability. Which pair correctly states those weaknesses? Your options are: A. The firm can dissolve when a partner dies or withdraws, and it cannot tap public capital markets the way a corporation can. B. The firm is taxed twice and ownership transfers automatically to the public. C. The firm has perpetual life and it can issue freely tradable stock. D. The firm must have at least 100 partners and only one class of ownership. Which one is it? Pause the video if you need more time. The correct answer is A. The firm can dissolve when a partner dies or withdraws, and it cannot tap public capital markets the way a corporation can. That is correct because a partnership's continuity is fragile because it can dissolve when a partner dies or withdraws, and while it raises more than a proprietorship, it still cannot tap public capital markets like a corporation. Those are two of its core structural drawbacks. B is wrong because partnerships are taxed once as pass-through entities, not twice, and ownership does not transfer automatically to the public. This misstates both features. C is wrong because perpetual life and freely tradable stock are corporate features, not partnership features. A partnership has neither. D is wrong because the 100 owner and single class limits describe an S corporation, not a general partnership. Partnerships have no such statutory caps. Beyond who bears the debts, A partnership has two structural weaknesses that shape whether it can grow and last: fragile continuity and limited access to capital. Because a partnership is fundamentally a relationship among particular people, one partner's exit can end it. Continuing the business means forming a brand new agreement, unlike a corporation, whose existence carries on untouched as shareholders come and go. Picture the partnership as a structure built directly out of its partners. So removing one weakens the whole thing, while a corporation stands as its own separate structure, existing independently of whoever happens to own shares. A partnership can pool more money than a sole proprietor, but it still cannot sell shares to the public or issue bonds to thousands of investors. Selling a stake also requires the other partner's agreement, making partnership interests illiquid and unattractive to outside investors. These two weaknesses, not liability alone, defend the partnership's meager ceiling. Once a business wants to outlive its founders and raise serious outside money, it converts to a corporation to escape both limits at once. Question 26. A startup founder expects to raise money from thousands of outside investors over time and wants to give them shares that can be freely bought and sold. Which form of business organization best supports that goal? Your options are A. Sole proprietorship, B. General partnership, C. Limited partnership, D. Corporation. Take a second. Which answer would you pick? The correct answer is D. Corporation. D is correct because only a corporation can sell stock to thousands of investors and issue bonds, giving it by far the greatest access to capital, and its shares can be freely transferred. That is exactly what the founder needs. A is wrong because a sole proprietorship's equity is capped at what one person is worth and cannot issue shares to outside investors. Its capital access is very limited. B is wrong because a general partnership cannot tap public capital markets and cannot issue freely tradable shares. Bringing in many outside investors this way is not feasible. C is wrong because a limited partnership can add limited partners but still cannot sell freely tradable public shares to thousands of investors the way a corporation can. Its capital reach falls short of the corporation's. When a business needs to raise huge sums from thousands of investors, one legal form beats every other option. Understanding why the corporation dominates big business starts with what it actually is. A corporation is a legal entity separate from its owners, created under state law. It can own property, sign contracts, and outlive any individual owner, and its owners are shareholders who hold shares of stock. Ownership is divided into shares that can be sold to many investors at once and traded freely afterward. The corporation can sell stock to thousands of buyers, large or small, and issue bonds to borrow from the public too. A sole proprietorship is capped at what one person can supply, and a partnership at what its handful of partners can muster. Only the corporation, by slicing ownership into many tradable shares, can assemble money from a vast pool of people who each share the risk. Because a shareholder can sell stock without disrupting the business, investors are far more willing to commit money, knowing it isn't locked away forever. That liquidity widens the pool of willing investors and deepens the capital the corporation can raise. Superior capital access is the corporation's defining commercial advantage, the reason it prevails wherever large sums are needed. Whenever a scenario points to raising serious money from many investors, it is pointing toward the corporation. Question 27. A community bank is organized as a corporation and hundreds of local residents own its shares. If the bank fails owing more than its assets, what is the exposure of an ordinary shareholder? Your options are: A. Shareholders must personally cover the bank's remaining debts in proportion to their holdings. B. Shareholders can be pursued for the full shortfall because they are the owners. C. Shareholders can lose only what they invested in the shares, and their personal assets are shielded. D. Shareholders face unlimited liability unless they also sit on the board. Before I reveal it, which one do you think is right? The correct answer is C. Shareholders can lose only what they invested in the shares, and their personal assets are shielded. C is correct because a corporation gives shareholders limited liability, so they can lose only what they invested, and their personal assets are shielded from the firm's debts. That shield is one of the corporation's defining advantages. A is wrong because shareholders are not required to cover the firm's debts beyond their investment. Proportional personal liability would defeat the purpose of limited liability. B is wrong because being an owner of a corporation does not expose a shareholder to the full shortfall. The corporation is a separate legal person responsible for its own debts. Ownership here does not mean personal liability. D is wrong because serving on the board does not strip a shareholder of limited liability. The liability cap applies to shareholders regardless of board membership. What makes a corporation truly safe for its owners is a legal wall between the company's debts and the owner's personal wealth. If a corporation fails, shareholders lose only what they pay for their shares, nothing more. This works because the corporation is a separate legal person. Its debts belong to it, not to its shareholders. So creditors can seize the company's assets, but never a shareholder's house or savings. Picture the corporation and its owners as two separate zones divided by a legal wall. Creditors can chase the company's debts and assets, but the wall stops them from ever touching a shareholder's personal wealth. This is the line that separates business forms. Sole proprietors and general partners face unlimited liability with their personal assets exposed, while corporate shareholders' risk is capped entirely at their investment. By capping the downside, limited liability invites huge numbers of investors to supply capital they'd never risk otherwise. That shield and the corporation's power to raise money on a massive scale are truly the same thing. Question 28. A large corporation's founder sells all her shares and retires, and several other original investors do the same over the following year. What happens to the corporation as a legal entity? Your options are: A. It dissolves once its original owners depart. B. It continues operating uninterrupted because it is a separate legal entity with perpetual life. C. It must be reorganized as a partnership among the new owners. D. It loses its limited liability protection until new owners are approved. What's your answer? Commit to one before I continue. The correct answer is B. It continues operating uninterrupted because it is a separate legal entity with perpetual life. B is correct because a corporation is separate and distinct from its owners, so it has perpetual life and keeps going when shareholders sell out or die. Shares can change hands without disrupting the business. A is wrong because a corporation does not dissolve when its original owners leave, unlike a sole proprietorship. Its existence is independent of any particular owner. C is wrong because ownership changes do not force a corporation to become a partnership. Its legal form persists through transfers of stock. D is wrong because transferring shares does not suspend limited liability. The shield continues regardless of who currently owns the stock. A corporation can last indefinitely. Founders retire, shareholders come and go, managers turn over, yet the corporation itself keeps going, because it is a legal person separate from the people who own it. Ownership can change hands completely, but the corporation itself doesn't pause or dissolve. Its contracts, employees, and operations simply carry on under new owners. This is a sharp contrast to simpler business forms. A sole proprietorship dies with its owner, and a partnership can dissolve when a partner departs, because neither has a legal existence apart from its specific owners. The key is separation. The corporation holds its contracts, employees, and operations as its own legal entity, distinct from whoever happens to own its stock at any given moment. That separation is what lets ownership change while the business itself remains untouched. Perpetual life and easy transfer of ownership are really two expressions of the same underlying fact, that the corporation is legally separate from its owners. That separation is what lets it plan across decades and makes it the vehicle of choice for enterprises built to endure. Question 29. A corporation earns a profit, pays corporate income tax on it, and then distributes part of the after-tax profit to shareholders, who report that money as taxable income on their own returns. What is this pattern called? Your options are A. Double taxation, B. Pass-through taxation, C. An interest tax shield, D. Tax deferral. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. Double taxation. A is correct because double taxation occurs when corporate profits are taxed at the company level and then taxed again as dividends at the shareholder level. The same money is effectively taxed twice, which is the corporation's signature tax drawback. B is wrong because pass-through taxation means income is taxed only once, at the owner level, which is the opposite of what is described. Partnerships, LLCs, and S-Corp are passed through. C is wrong, because an interest tax shield refers to the tax savings from deducting interest on debt, not to taxing dividends twice. It is unrelated to the pattern described. D is wrong because tax deferral means postponing tax to a later period, not paying it twice on the same profit. The scenario shows two separate taxes, not a delay. The corporation's biggest financial drawback is that the same earnings get taxed twice. Let's trace exactly how that happens and why. First, the corporation earns a profit and pays corporate income tax on it. Then it distributes some of what's left as dividends. Finally, the shareholder who receives that dividend pays personal income tax on it too. The same earnings hit twice. This happens because the corporation is its own separate legal person, so it is taxed as its own person apart from its owners. That separateness is also what gives it limited liability and perpetual life. Pass-through entities like partnerships, LLCs, and S-corporations avoid this entirely. Their income is taxed only once on the owner's return. Only the standard C corporation suffers the double hit. Double taxation is simply the cost a corporation accepts in exchange for limited liability, perpetual life, and unmatched access to capital. Only the corporation pays that toll. Every other common business form is taxed just once. Question 30. An analyst notes that in the corporate form, the owners usually are not the managers, and this feature is the reason a particular problem bites hardest in corporations. Which problem is it, and why does the corporate form intensify it? Your options are A. Double taxation because managers file separate returns. B. Unlimited liability because managers can be personally sued. C. Weak capital access because owners refuse to fund managers. D. The agency problem because separating ownership from control lets managers pursue their own interest over owners' wealth. Which would you go with? Lock it in before the reveal. The correct answer is D. The agency problem, because separating ownership from control lets managers pursue their own interest over owners' wealth. D is correct because in a corporation, owners such as shareholders usually are not the managers, and that separation of ownership and control is where the agency problem bites hardest. Managers can pursue their own interests instead of maximizing owners' wealth. A is wrong because double taxation stems from how corporate profit and dividends are taxed, not from the split between owners and managers. It is a tax feature, not an ownership control issue. B is wrong because corporations provide limited liability, not unlimited. So this misstates the corporate form. The problem intensified by the ownership control split is the agency problem. C is wrong because corporations have the strongest capital access, not weak access. The feature described, owners not being managers, points to the agency problem rather than a funding shortfall. Every strength of the corporation comes with a matching vulnerability. The very feature that lets it raise huge amounts of capital is the same feature that opens the door to a deep governance problem. The separation is structural. Dispersed shareholders elect a board. The board hires managers, and those managers actually run the company. This layering lets thousands of passive investors own one firm, but it also pries ownership apart from control. In that gap, managers control operations and information while distant. Scattered shareholders cannot easily monitor them. A manager may favor personal comfort or ambition over raising the share price, and dispersed owners may struggle to notice or stop it. The reason it bites harder in a corporation is dispersion. Sole proprietors and partners run their own businesses, leaving little gap for conflict. But in a large corporation, each shareholder owns too small a slice to justify close oversight, so managers gain latitude. This is a feature of the corporation's architecture, not a failure of particular people, which is why boards, audits, and stock-based incentive pay exist to contain a gap the form can never fully close. The advantage and the vulnerability are two sides of the same design. Question 31. A mid-sized business owner wants three things at once: protection of her personal assets from business debts, income taxed only once on the owner's personal returns, and the freedom to either run the firm herself or hire managers. Which form delivers all three? Your options are A. AC Corporation, B. A limited liability company, C. A sole proprietorship, D. A general partnership. Don't overthink it. Which one feels right? The correct answer is B. A limited liability company. B is correct because a limited liability company gives its members limited personal liability like a corporation, pass-through single taxation like a partnership, and flexible management where members run it or hire managers. That combination matches all three wants. A is wrong because AC Corporation provides limited liability but suffers double taxation, so income is not taxed only once. It fails the single taxation requirement. C is wrong because a sole proprietorship is single taxed, but gives the owner unlimited personal liability, failing the asset protection requirement. It also has only one owner. D is wrong because a general partnership is single taxed, but exposes general partners to unlimited liability, so it does not protect personal assets. It fails the liability requirement. Imagine a business owner who wants three things at once: protection for her personal assets, single taxation of profits, and freedom to run her company her way. Older business forms force a trade-off. The LLC was invented to end that forced choice. A corporation protects your personal assets but taxes profits twice. A partnership taxes profits once but leaves your personal wealth exposed to business debts. Business owners wanted a way out of this trade-off entirely. The LLC borrows its liability shield from the corporation, treating the business as a legal entity separate from its owners called members. It borrows pass-through taxation from the partnership, so profits are taxed only once, on the members' personal returns. This combination gives members a liability shield, single pass-through taxation, and flexible management, run by members themselves or by hired managers, with far fewer of the meetings and filings a corporation requires. The LLC removes the two features owners fear most: unlimited liability and double taxation, without demanding much in return. Its one limit is raising public capital, but short of that ambition, it's hard to beat. Question 32. The course describes hybrid forms as inventions meant to capture the best of two other forms. Which specific combination were LLCs and S corporations designed to provide? Your options are A. Unlimited liability together with double taxation. B. Perpetual life together with public share trading. C. The limited liability of a corporation together with the single pass-through taxation of a partnership. D. The simplicity of a sole proprietorship together with mandatory government ownership. Got a guess? Lock it in. The correct answer is C. The limited liability of a corporation together with the single pass-through taxation of a partnership. C is correct because the hybrids were created to combine the limited liability of a corporation with the single pass-through taxation of a partnership. That pairing removes the two biggest pain points of the other forms. A is wrong because unlimited liability and double taxation are the drawbacks the hybrids were designed to avoid, not provide. This is the opposite of their purpose. B is wrong because perpetual life and public share trading describe advantages of the large public corporation, not the defining hybrid combination. The hybrid signature is limited liability plus pass-through tax. D is wrong because hybrids do not involve mandatory government ownership, and their appeal is not mere simplicity. They pair limited liability with single taxation. Business forms weren't handed down by nature, they were designed to solve problems, and the hybrid forms are the clearest case of design meeting a need. For a long time, owners faced a frustrating choice. A corporation gave limited liability but taxed income twice. A partnership taxed income only once but left owners personally exposed to unlimited liability. Limited liability belonged to the corporation. Single pass-through taxation belonged to the partnership. The hybrid forms were built to merge these two features into one entity. The LLC is a distinct entity designed from the ground up to offer both features with flexible management. The S corporation is an ordinary corporation that simply elects special tax treatment. Different routes, same destination, limited liability paired with single taxation. That pairing is a signature of every hybrid form. Whenever owners want to shield their personal wealth and avoid double taxation, a hybrid is the structure built to deliver both. Question 33. A corporation has elected S corporation tax status. Which set of restrictions must it live within to keep that status? Your options are A. No more than 100 shareholders and only one class of stock. B. No more than 500 shareholders and unlimited classes of stock. C. At least 1,000 shareholders and foreign ownership required. D. No limit on shareholders but a ban on any citizen owners. Which one is it? Pause the video if you need more time. The correct answer is A. No more than 100 shareholders and only one class of stock. A is correct because an S corporation is limited to 100 shareholders and may have only one class of stock, and its shareholders generally must be citizens or residents. Those caps are the classic S corp restrictions. B is wrong because the shareholder cap is 100, not 500, and an S corp may have only one class of stock, not unlimited classes. This overstates both limits. C is wrong because an S corp has an upper limit of 100 shareholders, not a 1,000 minimum, and foreign ownership is generally not allowed. This reverses the actual rules. D is wrong because an S corp does have a shareholder cap of 100, and its owners generally must be citizens or residents rather than banned from being citizens. Both halves are wrong. The S corporation offers a great deal. The liability shield of a corporation with the single taxation of a partnership. But that deal only holds inside a strict fence of rules, and those rules define exactly what the form can and cannot be. There are 3 key restrictions. First, a hard cap of 100 shareholders. Second, only one class of stock is allowed, so no special tiers for dividends or voting power. Third, shareholders must generally be individual US citizens or residents, not corporations or foreign investors. Think of these rules as a fence built around a small farm. A modest, closely held business fits comfortably inside it, but a sprawling enterprise chasing thousands of diverse investors simply cannot squeeze through. Picture the company at the center, ringed by its ownership boundary, individual US. Owners fit inside while corporations and foreign investors are kept firmly outside the line. Remember the two headline limits: no more than 100 shareholders and only one class of stock. Those two facts explain why the S corporation suits small, closely held firms, while fast-growing companies eventually outgrow it and become a C corporation instead. Question 34. Which statement most accurately describes what an S corporation is? Your options are A partnership that is elected to be taxed as a corporation and face double taxation. B. A certification granted by a non-profit for social performance. C. A sole proprietorship with more than 100 owners. D. A corporation that has elected special tax status so income passes through to shareholders and is taxed only once, while shareholders keep limited liability. Take a second. Which answer would you pick? The correct answer is D. A corporation that has elected special tax status so income passes through to shareholders and is taxed only once, while shareholders keep limited liability. D is correct because an S corporation is legally a corporation, with the same liability shield that elects special tax status so its income passes through and is taxed once, sidestepping double taxation. Shareholders still enjoy limited liability. A is wrong because an S corp is a corporation electing pass-through tax, not a partnership electing double taxation. The direction of the election and the base form are both wrong here. B is wrong because a non-profit certification for social performance describes a certified B corporation, not an S corporation. The two are unrelated. C is wrong because a sole proprietorship has exactly one owner and is not a corporation. An S corp is a corporation with up to 100 shareholders. The S corporation is often treated as a mysterious separate business type, but it's really just an ordinary corporation that has made a special tax election. Getting that definition right clears up almost all the confusion around it. Start with the corporation part, the foundation. It has shareholders, stock, and full limited liability, exactly like any ordinary corporation. The special part is the tax election, which lets qualifying income pass through and be taxed only once on shareholders' personal returns. A standard C corporation is taxed on its profits, then shareholders are taxed again on dividends. That's double taxation. By electing S status, the corporation skips the entity level tax entirely, so earnings face just one layer of tax on the owner's returns. Compared to a C corporation, it's identical in legal form but taxed once instead of twice. Compared to a partnership, it shares that single taxation but adds full corporate liability, protection, and structure, making it a genuine hybrid. The S simply names a tax election, not a new kind of company. A firm can switch between S and C status without ever changing its legal nature, because the corporate skeleton stays put while only the tax treatment flips. Question 35. A fast-growing firm organized as an S corporation now wants to raise capital by issuing several different classes of stock to a large number of investors, including other companies. Why must it typically convert to a regular C corporation to do so? Your options are A. Because an S corporation cannot offer any liability protection to owners. B. Because the S corporation's limits of 100 shareholders and a single class of stock block that kind of expansion. C. Because a C corporation is taxed only once while an S corporation is taxed twice. D. Because only a C corporation can be a pass-through entity. Before I reveal it, which one do you think is right? The correct answer is B, because the S corporation's limit of 100 shareholders and a single class of stock block that kind of expansion. B is correct because an S corporation is capped at 100 shareholders and one class of stock. So a firm that wants many investors, multiple stock classes, and corporate owners outgrows those limits. Converting to a C corporation removes the caps. A is wrong because an S corporation does provide limited liability to its shareholders, so that is not the reason to convert. The binding constraints are the shareholder and stock class limits. C is wrong because the tax picture is the reverse. An S corp enjoys single taxation while a C corp faces double taxation. The firm accepts double taxation as the price of scale, so tax is not the driver of the conversion. D is wrong because a C corporation is not a pass-through entity. It is taxed at the corporate level. Pass-through status is an S corp feature, not a reason to become a C corp. Every successful S corporation eventually faces the same wall, its own rules. To grow the way it wants, it must give something up. The binding constraints are the S corporation's own rules, a cap of 100 shareholders, a single class of stock, and ownership generally close to corporations and foreign investors. Each growth ambition collides with one of these specific limits. Converting to a C corporation removes all of those limits at once, allowing unlimited shareholders, multiple stock classes, and owners of any kind, including institutions and foreign investors. The price of that freedom is losing pass-through taxation. As a C corporation, profits are taxed once at the corporate level and again as dividends. The double taxation that is the standard corporation signature drawback. This is why the largest companies are C corporations while smaller, closely held firms so often remain S corporations. The conversion isn't a mistake, it's maturation, each form fitting the company's stage of growth. Question 36. An outdoor apparel company passes a rigorous assessment run by the non-profit B Lab, meets verified standards for its impact on workers and the environment, and earns a credential it must renew periodically. What has the company become? Your options are A. A benefit corporation registered with the state. B. A limited partnership. C. A certified B corporation. D. A master limited partnership. What's your answer? Commit to one before I continue. The correct answer is C. A certified B corporation. C is correct because a certified B corporation is a certification granted by the non-profit B Lab to for-profit firms that meet verified social and environmental standards and recertify periodically. The described credential from B Lab is exactly that. A is wrong because a benefit corporation is a legal status registered with the Secretary of State, not a certification earned from B Lab. The scenario describes a credential, not a change in legal form. B is wrong because a limited partnership is an ownership structure with general and limited partners and has nothing to do with a social performance credential. It is unrelated to B Lab. D is wrong because a master limited partnership is an exchange-traded natural resource entity, not a social certification. It does not fit the described assessment. A certified B corporation is a certification, not a legal form. It's granted by a non-profit called B Lab to for-profit companies that meet verified standards for social and environmental performance, accountability and transparency. Just as an organic seal promises an independent check on how food was grown, the B Corp label promises an independent check on how a business behaves. The company keeps whatever legal form it already had, usually a corporation or an LLC, and simply layers this credential on top. Earning the certification takes real work. A company must score high enough on B Lab's assessment covering workers, customers, community, and environment. Meet transparency requirements by making its performance public. Make a legal commitment by amending its governing documents to consider all stakeholders. and recertify periodically to prove it still meets the bar. The distinction most worth holding is that a B Corp is a private credential from a non-profit, not a government-granted legal status. That's exactly what separates it from a benefit corporation, which is a legal status granted by the state. B Lab sets the standard, the company proves it meets it, and the certification signals that achievement, while the company keeps its for-profit ambitions and underlying legal form. Holding that picture makes the B Corp easy to recognize and easy to tell apart from the legal status it's so often confused with. Question 37. A founder amends her company's formation documents, filed with the Secretary of State, to insert language legally requiring directors to pursue a public benefit alongside profit. What has the company become? Your options are a benefit corporation, B, a certified B corporation, C, a conglomerate, D, a joint venture. Pick one, trust your gut. Here's your chance to test yourself. The correct answer is A, a benefit corporation. A is correct because a benefit corporation is a legal status adopted by amending formation documents filed with the Secretary of State, which legally requires directors to pursue a public benefit alongside profit. That is precisely what the founder did. B is wrong because a certified B corporation is a certification earned from the non-profit B Lab, not a legal status created by amending state filings. The scenario describes a legal change, not a credential. C is wrong because a conglomerate is a parent company owning firms in unrelated industries, unrelated to pursuing a public benefit. It does not fit the described filing. D is wrong because a joint venture is an alliance for a limited objective between firms, not a legal commitment to a public benefit written into formation documents. Let's untangle a distinction that trips up a lot of people. The benefit corporation is not the same kind of thing as the certified B corporation. A company becomes a benefit corporation by amending its formation documents and filing that change with the Secretary of State. This inserts language that legally requires directors to pursue a public benefit alongside profit, making it a change in what the company legally is. Ordinary corporate law expects directors to put shareholder value first, so a director who sacrifices profit for a social goal risks being sued. Benefit corporation status rewrites that legal duty, giving directors both cover and a mandate to weigh more than profit. This is government machinery. The amendment is filed and accepted by the state, and the company holds a new legal status. That's why it's properly called a status, not a certification. Becoming a benefit corporation even helps satisfy one requirement for B Corp certification, so a company can hold one, the other, both, or neither. But the surest way to keep them apart is to remember the grantor. The benefit corporation comes from the state, the B Corp from a non-profit. Question 38. The benefit corporation designation rests on three core tenets that the exam expects by name, which said correctly list all three. Your options are A, profit growth and scale, B, liability, taxation and control, C, purpose, profit and publicity, D, purpose, accountability and transparency. Which would you go with? Lock it in before the reveal. The correct answer is D, purpose, accountability and transparency. D is correct because a benefit corporation rests on three tenets: purpose, accountability and transparency, often remembered as PAT. Purpose sets the public benefit mission, accountability binds directors to all stakeholders, and transparency requires a public benefit report. A is wrong because profit, growth, and scale are business ambitions, not the three legal tenets of a benefit corporation. The correct trio is purpose, accountability, and transparency. B is wrong because liability, taxation, and control are the dimensions for comparing forms of business organization, not the benefit corporation tenets. They belong to a different topic. C is wrong because purpose is correct, but profit and publicity are not tenets. The accurate second and third tenets are accountability and transparency. The benefit corporation rests on 3 pillars the exam expects you to know by name: purpose, accountability, and transparency, easily remembered as PAT. Purpose asks why the company exists. Accountability asks whom its directors must answer to. And transparency asks what the company must disclose. Together these define what makes a benefit corporation different from an ordinary one. Purpose is written into the charter as a commitment to general public benefit. Accountability then binds directors to weigh the interests of workers, customers, the community, and the environment, not just shareholders. Transparency forces the company to publish a benefit report against an independent standard, so outsiders can judge whether it's living up to the other 2. Purpose declares the mission, accountability compels directors to serve it, and transparency exposes the results so the commitment can't be quietly abandoned. Remove any one pillar and the whole structure weakens. The exam tests this trio precisely because it's easy to mix up with imposters like profit, growth, and publicity. Hold on to purpose, accountability, and transparency, and you hold the whole legal substance of a benefit corporation. Question 39. One tenet of a benefit corporation requires the company to publish a periodic report assessing its social and environmental performance, usually against an independent third-party standard, and make it public. Which tenet is this? Your options are A. Purpose, B. Accountability, C. Transparency, D. Liability. Don't overthink it. Which one feels right? The correct answer is C. Transparency. C is correct because transparency is the tenet requiring the company to publish a periodic benefit report on its social and environmental performance, usually against an independent standard available to the public. Publishing that report is the transparency obligation. A is wrong because purpose requires the company to have a corporate purpose of creating a general public benefit, not to publish a performance report. Purpose sets the mission rather than the disclosure. B is wrong because accountability requires directors to consider the impact of decisions on all stakeholders, not to publish a public report. It governs decision-making, not disclosure. D is wrong because liability is not one of the benefit corporation tenets at all. The disclosure obligation described is transparency. Of the 3 tenets that define a benefit corporation, transparency is the one aimed outward at the public the company claims to serve. It requires the company to publish a periodic report on its social and environmental performance so that its promises can actually be checked. The substance of this tenet is disclosure. A benefit corporation must produce a benefit report covering its impact on workers, community, and the environment, measure it against an independent standard, and make it public rather than keeping it as a private memo. Using an independent standard gives the disclosure teeth. It keeps the company from grading its own homework, making the report comparable and credible instead of a glossy self-congratulatory brochure. Purpose is about the mission written into the charter. Accountability is about directors weighing all stakeholders in their decisions. Transparency is specifically about publishing the benefit report, the tenet's unmistakable signature. Transparency is the enforcement mechanism for the other 2 tenets, turning private assertions into public claims that can be checked, praised, or challenged. When you see a periodic public report measured against an outside standard, that is transparency at work. Question 40. What is the shared through line that connects both the Certified B Corporation and the Benefit Corporation back to the discussion of the firm's objective? Your options are A. Both eliminate the owner's liability entirely. B. Both broaden the director's fiduciary duty beyond pure shareholder wealth maximization to include other stakeholders. C. Both convert the firm into a tax-exempt non-profit. D. Both are required for any firm that wants to issue stock. Got a guess? Lock it in? The correct answer is B. Both broaden the director's fiduciary duty beyond pure shareholder wealth maximization to include other stakeholders. B is correct because both structures let a for-profit firm broaden the director's fiduciary duty beyond shareholders, overriding the default of pure stockholder wealth maximization. That shared expansion of duty is the through line back to the objective of the firm. A is wrong because neither structure eliminates owner liability. They address fiduciary duty and social commitment, not the liability shield. Liability is a separate dimension. C is wrong because both remain for-profit entities, not tax-exempt non-profits. Staying for-profit is what lets them scale while pursuing a mission. D is wrong because neither is required to issue stock. Ordinary corporations issue stock without becoming a B Corp or benefit corporation. They are optional commitments, not prerequisites. The certified B Corporation and the benefit corporation look almost nothing alike mechanically, yet they share one deep purpose that ties back to the most basic question in corporate finance. Whom does the firm actually serve? Recall the standard corporation's default objective: maximize shareholder wealth, under the doctrine of shareholder primacy, unless the charter states otherwise. That last clause is the opening both structures walk through. The benefit corporation broadens duty through law, legally requiring directors to weigh a public benefit and all stakeholders. The certified B Corporation broadens duty through a verified commitment, requiring amended governing documents plus B Labs outside standards. One works through state filing, the other through private certification, but both bind the company to answer to more than its shareholders. Picture the board's duty as a circle that starts narrow, owners only, and gets deliberately widened to include workers, customers, communities, and the environment, whether that widening happens through law or through certification. These structures are the practical response to the shareholder primacy debate, turning a philosophical objection into workable business forms. Whether by legal status or verified certification, both deliberately widen the firm's duty beyond its owners. Question 41. A single global parent company owns an aircraft engine maker, a broadcast network, and an appliance brand, and each subsidiary runs largely on its own in a different, unrelated industry. What kind of structure is this? Your options are A. A conglomerate. B. A joint venture. C. A horizontal merger. D. A master limited partnership. Which one is it? Pause the video if you need more time. The correct answer is A. A conglomerate. A is correct because a conglomerate is a parent company that owns multiple smaller companies operating in different, often unrelated industries, each running largely independently. A parent over an engine maker, a broadcaster, and an appliance brand fits that definition. B is wrong because a joint venture combines only parts of firms for a specific, limited objective, not a permanent parent owning several whole companies across industries. The described ownership is broader and ongoing. C is wrong because a horizontal merger combines competitors in the same market, not unrelated businesses under one parent. These subsidiaries are in different industries, not the same market. D is wrong because a master limited partnership is an exchange-traded natural resource entity, not a diversified parent over unrelated industries. It does not match the structure. Picture one corporation that owns a jet engine maker, a television network, and an appliance brand all at once. That's a conglomerate, a corporation that owns multiple smaller companies operating in different, often unrelated industries. A conglomerate is built by acquisition and diversification, not by focusing on one trade. One subsidiary might make jet engines, another produces appliances, and a third broadcasts television, with no need for the industries to connect. Independence of the subsidiaries is central to the model. Each business operates separately with its own management, products, and markets, while the parent's role is ownership and capital allocation rather than day-to-day operation. The picture is one parent sitting above several independently run companies, owning them and allocating capital while each subsidiary manages its own products and markets. The purpose is diversification. By owning unrelated businesses, the parent spreads its bets so a downturn in one industry can be offset by strength in another, smoothing overall performance. Whether that bet pays off is genuinely debatable, since running very different businesses under one roof carries both benefits and costs. Remember the picture: one parent, many independent companies, unrelated industries gathered for diversification. Question 42. An investor is evaluating a conglomerate. Which statement correctly pairs a primary benefit of the conglomerate form with its characteristic drawback? Your options are: A. Benefit, it avoids double taxation. Drawback, its owners face unlimited liability. B. Benefit, it guarantees a rising share price. Drawback, it is capped at 100 owners. C. Benefit, unrelated businesses diversify industry risk and smooth earnings. Drawback, the units lack cultural cohesion, making coordination hard. D. Benefit, all subsidiaries share one culture. Drawback, it cannot raise any capital. Take a second. Which answer would you pick? The correct answer is C. Benefit, unrelated businesses diversify industry risk and smooth earnings. Drawback, the units lack cultural cohesion, making coordination hard. C is correct because the conglomerate's headline benefit is diversification of industry risk, because unrelated subsidiaries can offset one another and smooth earnings, while its characteristic drawback is a lack of cultural cohesion that makes coordinating very different units hard. That pairing is accurate. A is wrong because avoiding double taxation is not a conglomerate feature, since a corporate parent still faces corporate tax, and its shareholders have limited, not unlimited liability. Both halves are wrong. B is wrong because a conglomerate guarantees no rise in share price and can even trade at a discount, and the 100 owner cap belongs to S corporations, not conglomerates. Neither half fits. D is wrong because a conglomerate's units famously do not share one culture, and a large corporate parent has strong capital access rather than none. This reverses both the benefit and the drawback. Every organizational structure has its own ledger of benefits and cost, and the conglomerate's ledger is unusually clean. One headline advantage set against one characteristic weakness. The advantage is diversification of industry risk. Unrelated subsidiaries rise and fall independently, smoothing overall earnings. The weakness is a lack of cultural cohesion across units, which makes them genuinely hard to manage together. Judging any conglomerate means weighing these two against each other. Picture a parent company holding subsidiaries in unrelated industries. When one industry slumps, another is holding steady or climbing. So the combined earnings line is smoother than any single business could produce alone. The drawback is real. Units in unrelated industries share no common culture, strategy, or playbook, and management attention gets stretched thin. This is why markets sometimes apply a conglomerate discount, valuing the whole below the sum of its parts, and why some conglomerates eventually break themselves up. The conglomerate is a real trade-off, not a guaranteed win. Sometimes smoothing industry risk is worth the cohesion cost, and sometimes the units are worth more apart. That's why the same firms that build sprawling conglomerates so often later dismantle them. Question 43. A publicly traded pipeline business passes its income through to investors with no corporate level tax, caps investors' liability at their investment, and is run by a sponsor who controls operations while the investors have little say. Which structure combines these three features? Your options are A C corporation, B, a conglomerate, C, a sole proprietorship, D, a master limited partnership. Before I reveal it, which one do you think is right? The correct answer is D, a master limited partnership. D is correct because a master limited partnership is defined by the combination of partnership pass-through taxation, limited liability for the entity's debts, and sponsor control, wrapped around natural resource assets and traded on an exchange. A pipeline business with exactly those three features is an MEP. A is wrong because AC Corporation faces double taxation and is controlled by a board elected by shareholders, not a sponsor over limited partner unit holders. It does not fit the pass-through sponsor-controlled description. B is wrong because a conglomerate is a parent owning firms in unrelated industries, not a single pass-through pipeline entity controlled by a sponsor. The described tax and control features do not match a conglomerate. C is wrong because a sole proprietorship has one owner with unlimited liability and is not exchange traded. It is the opposite of a sponsor-controlled limited liability publicly traded MLP. Certain investments reveal themselves through a distinctive combination of features, and the master limited partnership has one of the clearest fingerprints in finance. A master limited partnership is an exchange-traded investment structured as a limited partnership, concentrated in the exploration, processing, or transportation of natural resources. Its units trade publicly like stocks, but legally it remains a partnership, not a corporation. Three features together define the MLP. First, pass-through taxation. The entity pays no corporate level tax, avoiding the double taxation that burdens corporations. Second, limited liability. Unit holders' losses are capped at their investment. Third, sponsor control. A general partner runs the business while unit holders remain passive, trading control for that liability shield. Picture the sponsor as general partner steering the business, unit holders as limited partners holding exchange-traded units, and income flowing straight through the entity to investors without a corporate tax stop along the way. No single feature makes an MLP. It's the combination of pass-through taxation, limited liability, and sponsor control, wrapped around a publicly traded natural resource business. That is the signature of the structure. Question 44. A US car maker and a Japanese battery manufacturer each contribute capital and expertise to build one shared electric vehicle battery plant, and both parent companies keep running all their other businesses separately. What is this arrangement? Your options are A, a hostile takeover, B, a joint venture, C, a conglomerate, D, a forward vertical integration. What's your answer? Commit to one before I continue. The correct answer is B, a joint venture. B is correct because a joint venture joins parts of two or more companies to achieve a specific, limited objective while each company otherwise stays independent. Two firms building one shared plant and keeping their other operations separate is the signature pattern. A is wrong because a hostile takeover is an acquisition that targets management opposes, not a cooperative shared project. Nothing here is being acquired against anyone's wishes. C is wrong because a conglomerate is one parent owning many whole companies across unrelated industries, not two independents jointly running a single project. The firms here remain separate parents. D is wrong because forward vertical integration is buying a distributor or retailer down the supply chain, not forming a shared plant for a limited objective. No supply chain acquisition occurs here. Imagine a US car maker and a Japanese battery maker teaming up to build one shared battery plant while keeping every other part of their businesses completely separate. That arrangement is a joint venture. Parts of two companies joined for one specific goal, not a merger of the whole firms. A joint venture is best understood as a partnership for a defined purpose. Two or more firms each contribute resources, whether money, technology, or market access, to a shared project. And once that narrow goal is met, the partners go their separate ways. The benefits are clear. Partners share cost and risk, and each gains access to the other's strengths, making it easier and less drastic than a full merger. But shared ownership means divided control, and divided control breeds friction and conflict when priorities clash. Picture it visually. The car maker and the battery maker remain two separate companies, each committing only a slice of themselves into the shared plant, while the rest of their operations stay untouched and independent. The distinction worth holding on to: a joint venture combines parts of companies for a limited objective, while a merger fuses whole companies permanently. If the car maker and battery maker had combined entirely, that would be a merger, not a joint venture. Question 45. Investors are drawn to a certain exchange-traded structure because it concentrates in assets like oil and gas properties and pipelines that throw off predictable cash, and it is prized for its steady income distributions. Which structure is being described, and what is its main concentration? Your options are A Master Limited Partnership concentrated in natural resource and energy assets. B, a benefit corporation concentrated in social impact ventures. C, a conglomerate concentrated in unrelated consumer brands. D, an S corporation concentrated in technology startups. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. A master limited partnership concentrated in natural resource and energy assets. A is correct because a master limited partnership is an exchange-traded limited partnership focused on the exploration, processing, or transportation of minerals and natural resources, holding cash-generating assets like pipelines and oil and gas properties. Its steady distributions make it prized as an income vehicle. B is wrong because a benefit corporation is a legal status committed to a public benefit, not an exchange-traded energy asset structure prized for cash distributions. Its focus is social impact, not natural resources. C is wrong because a conglomerate spans unrelated industries and is not defined by natural resource concentration or steady pass-through distributions. It is a diversified parent, not an income-focused resource partnership. D is wrong because an S corporation is a closely held corporation with pass-through tax and a 100 shareholder cap, not an exchange-traded natural resource entity. It does not match the energy asset steady distribution description. Income-seeking investors love a certain hybrid. It trades like a stock but pays out like a bond. That hybrid is the master limited partnership, and understanding what makes it tick starts with what it owns. The MLP is defined by three traits together. It concentrates in natural resource and energy assets like pipelines. Its units trade on public exchanges just like stock, and it passes through steady cash distributions to unit holders. Pipelines are the classic example, collecting fees for moving oil or gas regardless of price. Picture a pipeline collecting a toll on every barrel that flows through it, regardless of whether oil prices rise or fall. That fee-based cash flow is passed through to unit holders, which is exactly why MLPs are prized for dependable income. These strengths come with a mirror image set of drawbacks. Unit holders have limited control since the sponsor runs everything. The MLP is concentrated in the energy sector's ups and downs. Tax reporting is more complex than a simple dividend form. and unit prices are sensitive to interest rates. The MLP is an income instrument first, a tax-efficient, exchange-traded way to own cash-generating energy assets. Whenever a scenario describes a publicly traded pipeline paying steady pass-through income, you're looking at an MLP. Question 46. Two competing regional airlines that serve the same market with the same kind of service decide to combine into a single company. Which type of merger is this? Your options are A backward vertical integration, B, a forward vertical integration, C, a horizontal merger, D, a joint venture. Which would you go with? Lock it in before the reveal. The correct answer is C, a horizontal merger. C is correct because a horizontal merger combines two companies in the same market, offering the same or similar products that are competitors. Two rival airlines in the same market combining is the classic horizontal merger. A is wrong because backward vertical integration is buying an upstream supplier, not combining with the same market competitor. No supplier is involved here. B is wrong because forward vertical integration is buying a downstream distributor or retailer, not merging with a direct competitor. The airlines are at the same stage, not different stages. D is wrong because a joint venture combines parts of firms for a limited objective while they stay independent. But here the two airlines fully combine into one company. That is a merger, not a JV. A horizontal merger happens when two direct competitors selling the same product to the same customers in the same market combine into a single firm. Picture two rival regional airlines flying overlapping routes deciding to join into one carrier. They occupied the same stage of the same industry, competing head-to-head before becoming a single company. The strategic logic centers on scale. Combining with a competitor grows market share, spreads fixed costs over a larger operation, and reduces the rivals a firm faces. The clearest test is whether two firms did the same thing before merging. Horizontal means same level of the supply chain, competitors combining, while vertical means joining different levels, like a supplier and its customer. Same market, same or similar products, direct rivals fused into a single firm to gain scale. Whenever two competitors in the same business join together, that merger is horizontal. Question 47. Two regional grocery chains operate in the same market and sell the same products, but they have never competed head-to-head because they serve entirely different neighborhoods. They now combine into one firm. According to the course, this is best described as which type? Your options are A standard horizontal merger between competitors, B, a lateral integration merger, C, a backward vertical integration, D, a conglomerate. Don't overthink it. Which one feels right? The correct answer is B, a lateral integration merger. B is correct because the course treats lateral integration as a horizontal style merger, where the firms are in the same market with similar products but are not competitors. Same market grocers that never competed head-to-head combining is exactly lateral integration. A is wrong because a standard horizontal merger involves direct competitors, but the STEM specifies these firms never competed. That non-competitor detail is what makes it lateral rather than plain horizontal. C is wrong because backward vertical integration is buying an upstream supplier, which is not happening here. Both firms are grocers at the same stage. No supply chain move occurs. D is wrong because a conglomerate owns firms in unrelated industries, but two grocery chains are in the same industry. The unrelated industry element is missing. One word separates a horizontal merger from a lateral integration merger: competitor. Both involve firms in the same market selling similar products, but whether those firms actually competed changes everything. Start with what they share because it's almost everything. Both merger types combine firms in the same market, selling the same or similar products at the same stage of the industry. That overlap is exactly why the distinction is so easy to miss. The difference is the competitive relationship, not the market or the product. If the firms were rivals fighting for the same customers, it's a horizontal merger. If they shared a market but never actually competed, it's lateral integration. Picture two regional grocery chains in the same market selling the same products, but serving entirely different neighborhoods and never competing for the same shoppers. When they merge, that's lateral integration, precisely because they were never rivals. The rule to hold on to: a horizontal merger joins same market competitors, while lateral integration joins same market firms that never competed. Everything else can look identical, so always check whether they were rivals before you label the merger. Question 48. A coffee roasting company buys the coffee bean farm that supplies the raw beans it roasts. From the roaster's perspective, which type of combination is this? Your options are A. A forward vertical integration, B. A horizontal merger, C. A lateral integration, D. A backward vertical integration. Got a guess? Lock it in. The correct answer is D. A backward vertical integration. D is correct because backward vertical integration is buying a company that is a supplier of raw materials or parts upstream in the supply chain. A roaster buying its own bean farm reaches back toward its inputs, which is backward integration. A is wrong because forward vertical integration reaches towards the customer by buying a distributor or retailer, the opposite direction. Buying a supplier is backward, not forward. B is wrong because a horizontal merger combines same stage competitors, but a farm and a roaster are at different stages of the supply chain. This is a vertical move, not horizontal. C is wrong because lateral integration is the same market, similar product combination between non-competitors, not the purchase of a supplier. The roaster and the farm are at different supply chain stages. Vertical integration moves a firm along its own supply chain, and the backward direction reaches toward the firm's inputs. When a company buys its own supplier, it has integrated backward, reaching upstream toward the source of what it needs to produce. Every firm sits somewhere along a chain running from raw materials through production to the final customer. Behind the firm are its suppliers, ahead of it are distributors and retailers. Backward integration means acquiring a business upstream toward the suppliers that feeds into the firm. The reasons a firm integrates backward center on control and cost: it secures its source of raw materials, captures the profit the supplier used to earn, and gains tighter control over quality and timing, all while reducing dependence on outside vendors. A coffee roasting company that buys the bean farm supplying its raw beans has integrated backward. The roaster has reached back along its supply chain to absorb the business that feeds it, which is the essence of backward integration. Backward integration always means reaching towards the inputs by buying a supplier, the mirror image of forward integration, which reaches toward the customer. Holding on to backward toward the source is what keeps this straight. Question 49. That same coffee roaster later buys a nationwide chain of cafes that sell brewed coffee directly to consumers. From the roaster's perspective, which type of combination is this? Your options are A. A forward vertical integration, B. A backward vertical integration, C. A horizontal merger, D. A hostile takeover. Which one is it? Pause the video if you need more time. The correct answer is A. A forward vertical integration. A is correct because forward vertical integration is buying an organization further along the supply chain towards the customer, such as a distributor or retailer. A roaster buying a chain of cafes that sell to consumers reaches forward toward its buyers. B is wrong because backward integration reaches toward inputs by buying a supplier, the opposite direction from buying retail cafes. Cafes are downstream, not upstream. C is wrong because a horizontal merger combines same-stage competitors, but a roaster and consumer-facing cafes sit at different stages of the chain. This is vertical, not horizontal. D is wrong because a hostile takeover is defined by the target's resistance, which the scenario does not mention. The defining feature here is the downstream direction of the purchase, making it forward integration. We just saw a roaster buy its bean farm, reaching backward. Now the same roaster buys a nationwide chain of cafes, reaching forward toward its customers instead. Forward integration means a company buys an organization further along its supply chain toward the buyer. That could be a wholesale distributor or a retailer, and either way, the firm extends its ownership downstream toward the point of sale. Picture the chain: bean farm, then roaster, then cafes. Buying the farm reaches backward, upstream toward the source. Buying the cafes reaches forward, downstream toward the customer. Firms integrate forward to capture the profit middlemen use to earn, to secure a guaranteed channel to customers, and to gain direct access to buyers and their information, controlling how the product is priced and presented. Always judge direction from the acquiring firm's side. Backward reaches toward the source. Forward reaches toward the customer. Buying the cafes that sell its coffee is the roaster's clearest forward move. Question 50. An acquiring firm buys up shares directly to seize control of a target company whose management and board are actively fighting the deal. What is this kind of acquisition called? Your options are A. A friendly negotiated merger. B. A joint venture. C. A hostile takeover. D. A lateral integration. Take a second. Which answer would you pick? The correct answer is C. A hostile takeover. C is correct because a hostile takeover is an acquisition in which the target firm's management and board oppose the deal. So the acquirer buys control against their wishes, typically by buying up shares. The active resistance of the target's board is what makes it hostile. A is wrong because A friendly. Negotiated merger is one both sides agree to, which is the opposite of the target fighting the deal. The resistance described rules out a friendly merger. B is wrong because a joint venture is a cooperative alliance for a limited objective, not a contested acquisition of control. There is no shared project here. D is wrong because lateral integration is a same market merger between non-competitors, unrelated to whether the target resists. The defining feature here is the board's opposition, which points to a hostile takeover. Most mergers are courtships where both sides agree, but some are conquests carried out over the target's objections. A hostile takeover is an acquisition where the target's management and board oppose the deal, yet the acquirer takes control anyway, typically by buying shares directly. The word hostile refers only to the target management's resistance, never to any illegality or wrongdoing. A friendly merger is negotiated cooperatively, while a hostile takeover is the same deal pursued without the board's consent. The mechanism is the market for shares. Since a public company's stock is owned by shareholders, an acquirer rebuffed by the board can go around it and buy shares directly. Enough shares means enough ownership to seize control, overriding the very management that objected. A hostile takeover is not fraudulent, and it isn't defined by whether the firms are horizontal or vertical in industry logic. It's defined purely by consent. Does the target's leadership agree or does it resist? What endures is this: a hostile takeover is acquired control against the target management's will. Resistance overcome by buying shares, with no requirement of wrongdoing at all. That wraps up our question and answer review for Domain 1, the financial manager and business organization. If you'd like some extra practice on everything we just covered, head over to our website. You'll find the link right down in the description below. Once you're there, you'll find hundreds of completely free practice questions, along with full study guides all ready and waiting whenever you need them most. Subscribe so you don't miss the next part, and good luck on your exam.